All right, Marissa.
Hey, welcome to today's First Friday, December webinar. Today's presentation is titled, What is the Most Likely Pathway Forward? Our prepared comments during this session will be recorded as other families who are unable to attend have asked us for the recording. My name is Marissa, and I will be your administrator today. Today's presentation will be 15 to 20 minutes, and we will be covering three main topics: why the tailwinds which created our inflationary environment will become headwinds, what the US stock market is missing. We have three incredibly important and interesting variables to discuss with you. And based on the data we have today, our base case for the stock market's fair value. If you have submitted questions, we want to thank you. Your questions help us understand what is truly important to each family we serve. If new questions emerge from the content of today's presentation, please either send the question along by typing your question in the chat box at the bottom of your screen, or you may click Reactions button at the bottom of your screen, and there will be an option to raise your hand. We will come to you at the end of the prepared comments to answer any questions. Please remember to mute your microphone and stay on mute, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Hi, everybody. So let me take a brief moment to welcome each of you to December's First Friday discussion and to thank you for attending. We like everybody to attend and welcome you. You know, as we said during November's First Friday town hall, we believe we may be entering a difficult period for all investors, and uncertainty is likely to increase over the next 6 months. And our goal is to help everybody develop reasonable expectations for what may be in front of us. We're going to continue to have these meetings on the first Friday of every month until our economy recovers and uncertainty becomes a bit more manageable for everyone. If these meetings are helpful during uncertain and potentially dangerous times, we'll continue to have the meetings longer than the next 6 months. And if we're wrong and the future is wonderful and rosy, we'll continue, we'll stop these discussions because they're just going to be unnecessary. So after this meeting, if you have the moment, please send us a short assessment of what you thought of the meeting. Meaning, tell us, help us know what to include in future meetings. Tell us what you feel like should be avoided. There's no diplomacy needed. You know, our goal is to continue to improve the relevance and the usefulness of the content we offer here. And our end goal is allowing each family that we serve to make really intelligent decisions about their wealth. So in today's First Friday meeting, we're going to first discuss why the tailwinds over the last 12 years are going to become headwinds. This is the most important part of our discussion today because it's quite likely to change everything. And we really want every member of our family office to understand what is most likely, or what the pathway most likely in front of us is. Second part of our discussion today is going to be what's the market missing, and it's the most it's always the most fun part for me. The reasons, capital markets are incredibly efficient. I know that people think that they aren't, but they really, really are. And everything that is known is likely currently priced into the information, into the current valuation. And what it really means is only information that is not widely known has the ability to move markets. And and when you know something that the market doesn't know, and you truly have a real informational advantage. And that's our goal here. So we're going to discuss three truly remarkable pieces of information that are not priced into the market. I can promise you that. And I was shocked. And we believe they will have an impact when they become priced into the market. Thirdly, As always, we're going to tell you what we believe the market's fair value is, and it's going to answer the title question, which is what's the most likely pathway forward for the marketplace. And I want to remind you that we're always going to talk about or answer the standard question that every self-respecting analyst poses before making the decision, which is what happens if our analysis or conclusions are wrong. So first, why are tailwinds becoming headwinds? So this is the most important topic because it's the basis for all stock market values. And we went through this last week, so we'll move quickly through these slides as most of you have already seen this. Slide 2 is our national debt load. Today we find ourselves, or our US economy, with the highest amount of debt in history. Higher debt creates higher risks. Slide 3 shows that we have come from almost no debt, and you may remember this slide, to over 25 trillion in debt, and the pace of indebtedness is increasing, not decreasing. Don't forget, documented research shows that when an economy becomes more than 90% indebted, growth slows. Today, our debt levels are close to 140% of our GDP. The point is, US growth will slow, and it will become increasingly difficult for us to pull out of this vicious cycle. Our corporate market has also increased its leverage, and it's increased its leverage at an alarming rate. Why do we care? Because increasing debt allows companies to increase their earnings. Leverage increases earnings during good times, and it really decreases earnings during difficult times. It has a levered effect on both the up and the downside. And by the way, as the slide shows, leverage really is one of the oldest tricks in the book for Wall Street. It allows you to change the valuations of financial assets without really changing the fundamental value of a company. All of this was facilitated, all of this increasing debt and increasing earnings, it's all been facilitated by a massive decrease in interest rates. Lower rates allow more debt on the balance sheet, which creates higher earnings. And just when you thought the backdrop or the tailwinds for corporate America couldn't get any better, as we said last week, voila, the United States administration lowers corporate tax rates, and we're off to the races again. Lower corporate tax rates directly, one for one, increased earnings overnight. So here we are today, having just lived through more than 15 years of wonderful earnings. And for many investors, the last 15 years have been a lifetime. Now, and they expect this type of chicanery to continue. This is not a damning statement towards any investors. Just it happens. It's been happening for so long. You just believe that it's par for the course. Yet history and research shows we've had this incredible help with layer upon layer of tailwinds. Every one of those tailwinds now is likely to reverse in the immediate future. So corporate debt will not continue to increase. In fact, it may have to come down, which will lower earnings. Interest rates, they're unlikely to be lower, and interest rates may well be higher over the next 10 years, which will lower earnings. And corporate taxes, they're more likely to be higher than lower, again, lowering earnings. While each major tailwind is becoming a headwind, Wall Street is tone deaf. Wall Street forecasts the S&P 500 is going to grow earnings by 7% in 2022. And they're going to grow earnings by more than 7% in 2023 and in 2024. And so while nothing is impossible, the facts and the probabilities argue for earnings to be lower over the next few years, not higher over the next few years, which is going to be a shock to the marketplace. So while anything's possible, the economic forecast or the economic framework moving forward clearly says U.S. asset values are overvalued and they're much more likely to be lower in the future. So now, here comes the most important or the most interesting portion of the First Friday meeting. What is the market missing? 3 topics. Last week, we missed one significant influencer and another one of Wall Street's great financial tricks. It's called share repurchases. You'll find this, I think you'll find this amusing. Slide 11, inflation, which is the devil our whole world is fighting right now. And on November 9th, the stock market took off. And reason it took off was because, and by the way, the NASDAQ increased more than 7% in one day. It was one of the best increases in history and it increased because the CPI inflation index reading decreased. Was the decrease real? Or could there have been a change in the way the CPI indicators were calculated? We're going to see. Is there another inflation misunderstanding? The stock market is priced for inflation to return to well under 3% in less than 1 year. In fact, before the end of 2023, inflation is supposed to be, or is expected to be, below 3%. And listen, I admit, while anything is possible, what do the last 20 plus inflationary bouts tell us? Research Affiliates did a great study on this, and by looking at the data, you may very well be surprised. I was. Share buybacks. How have they inflated earnings? Some studies show that repurchases have been as responsible for increases in earnings as the massive increase in debt. Classic example, a company has 10 shares outstanding. They earn $10 or $1 per share. The company borrows $5 and buys back 5 of those shares. Now the company has 5 shares outstanding and is still earning the $10. It's done nothing but change its balance sheet. Now the company's shares represent $2 per share in earnings, which will give them a higher valuation. Hocus pocus, Wall Street does it all the time. And some studies show that share repurchases have been as responsible for increases in earnings as the massive increases in debt have been. In fact, these share repurchases over the course of the last 15 years have overwhelmed share prices over the last 15 years. The gross amount of earnings after inflation have probably not increased at all, again, after inflation, over the last 12 years. Here's the important point. We find it hard to believe that corporate America will be able to lower debt, pay higher taxes and higher salaries, and continue to buy back the amount of shares consistent with the tactics that they've used over the last 15 years or so. And without share buybacks as a tailwind, earnings growth will become a headwind. So the next topic that we think the market is missing is inflation. Is it likely that inflation really has been whipped? After having increased from over 2% in 2020 to over 8% in 2022. Well, the market believes that it has. On November 9th, the market got a CPI index reading, which showed that inflation was lower by 0.3%. And it celebrated. Analysts expected a reading of 8% on inflation, and the CPI index was reported at 7.7%. Hooray! Inflation has been whipped. The S&P 500 was up over 5% in one day, 5% in one day. And the NASDAQ was up over 7% that day, a record amount of increase after a CPI print. Was the increase of several $1 trillion in market value, was it justified? Well, it just so happens that the calculation for the cost of healthcare changed in November. The cost of healthcare makes up a bit more than 8.4% of the CPI index. And as you can see, in November, the cost of healthcare calculated by this index change went from being up on a yearly basis by a bit over 6% to being down 4%. Now, I know this is a bit nerdy, yet does anybody on this call believe that the cost for healthcare broadly, one of the most consistently increasing costs of our U.S. economy, do you believe that it decreased by 4% in 1 month? The short answer is that the healthcare cost index calculation, it just changed. Yet the detailed market, I guess what I should say is the market overlooked this small detail and celebrated. By the way, just to let you know the significance of this change in the calculation, the lower healthcare number, the absolute number, represented over 100% of the total decrease in CPI for the November reading. So the question it really begs is inflation really declining? And our answer is no. Inflation persistence. The market believes, as I said earlier, and it's already priced in inflation returning to under 3% before the end of 2023. And if that happens, all is well. Truly, it would be great. And it may happen. However, history tells us there's more than an 80% chance this does not happen. So the market is betting on a 20% historical outcome. And we think it's highly unlikely that it returns to under 3% between now and the end of 2023. Here's why. Slide 19 shows that the rate of inflation on the x-axis was, so the x-axis is the horizontal axis. And it's showing the rate of inflation. And the number of years it takes for inflation to return to 3% is calibrated on the y-axis, and that's the vertical axis. Just for those who don't remember. This chart shows that once inflation passes 4%, it takes between 9 months and 7 years to return to 3% or less. So that's got a possibility of happening if inflation had only peaked at 4%. However, if inflation continues past 4% and passes 6%, it has historically taken between 2.5 years and 16 years to return to 3%. So So far, that would mean if it only passed 6% and turned around and came back down, that we would have a probability of 2.5 years as the lowest, as the fastest return to 3%, and as much as 16 years if it went on the other side of that against us. However, if inflation passed 8% like it did in 2022, it takes between 7 years at a minimum and 16 years to return to 3%. This is just history. It doesn't mean that history can't be broken. It just means this is what historical data tells us has happened. In short, it simply says that if inflation was to return to 3% before the end of 2023, from over 8% in 2022, it'd be a first. This is not to say it can't happen. However, the market is ignoring the most likely outcome by a long shot. The data clearly say the odds are greatly against this taking place. And what does it mean to us? And why it's important to understand that the market is missing this? The market believes inflation has peaked and it's going to return to 3% or under by 2023. And while it's possible, history tells us it's never happened. Just people don't look at the data. Once inflation has exceeded 8%, it's never returned to 3% in less than 5 years. And the average return to 3% took more than 7 years. So the bottom line is inflation is likely to be stickier than the market believes. This means the Fed is likely to keep rates higher for longer than the market believes. And each day the Fed keeps inflation or keeps interest rates elevated, it increases the probability of a recession, and a recession increases the probability that some part of our economy is going to break. And if something in our economy breaks with our current amount of leverage, the probability of a cascade of negative domino events increases. In short, of course, the future is unknown. You can't predict, but you can prepare. And that's what we're hoping this piece helps everybody think about. So it's likely, we believe, the pathway forward includes a likely margin contraction for corporate America. And this margin contraction, I think it's pretty easy for people to see, is being caused by interest rate increases, labor cost increases, and the inability of corporate America to eventually pass along those price increases to the consuming public. Probabilities tell us that when profit margins contract, so as profit margins are reduced from the levels we went through last week, which are at about 15%, history says that profit margins on average are about 8%. So as profit margins contract, all else equal, earnings decrease. When earnings decrease, the narrative is going to change from positive, which is, you hear it all the time, buy every dip, to negative, which is sell every bounce in the market. And what is fair value? History tells us the average multiple of earnings is slightly over 15 times earnings. And what will earnings be in 2022? The street expects slightly over $220 for the S&P 500. We believe as we enter a recession in 2023, and as earnings, we believe earnings will be less than $200 per S&P 500 share, which is a decline of about 8%, not an increase of 7%. Keep in mind that our prediction of, or our expectation that earnings will decrease by about 8% is pretty rosy, because a typical decline during a recession is slightly over 20% in earnings decline during a recession. So as I said earlier, as I just said, it may be a bit more optimistic than history supports. At a 15 multiple on $200 in earnings, you can do the math yourself. The fair value of the S&P 500 will be approximately 3,000. And the current valuation of the S&P 500 is slightly over 4,000, indicating that either earnings must increase by about 25%, or that valuations should be about 25% lower. Keep in mind that recessions matter. And I always spend a bunch of time with each of you talking about the likelihood of a recession. And in this slide, you can see why. The average difference between a bear market without a recession is slightly between 25%, and a bear market with a recession, the market is down by a little bit more than 45%. So what's the most likely pathway forward? While anything can happen, the odds are that after more than 15 years of above average returns and a Fed which has avoided letting any type of normal economic cycle of downturns to cleanse their economy of the companies which are unable to create value and profits, it's likely to be ending. We now find ourselves on the cusp of what I believe to be a more than light recession, with record amounts of debt and an inflation which may be much more sticky than the market expects, and a Fed that's trying to balance its two primary objectives. Keep in mind, the Federal Reserve of the United States has two primary objectives. They are supposed to be balancing full employment with price stability. Unfortunately, these two objectives are at odds with each other. They're directly opposing each other, to tell you the truth, especially during an inflationary environment. Because during an inflationary environment, the Fed has to increase interest rates, which slows the economy and decreases employment. As we said earlier, no one truly knows what's to come. So we can't predict with certainty, yet you can prepare with certainty. And with that said, I'm sorry for a little bit of a long-winded narrative. So let's take some questions these comments may have created.